Mr. Real Estate 100. Strategies to identify deals, strategies to identify opportunities. Earlier, we were talking about 2009, 2010, when there was a surplus of real property on the marketplace. Many of these properties were bank REOs, real estate owned properties, otherwise distressed properties, properties that were subject to short sales, whereby a homeowner seeks to sell their property and a lender agrees to take less than what's owed on the property. Well, 2009, 2010, and much of 2011 experienced a lot of these types of assets on the marketplace, in addition to what are called standard sales. Sales whereby the owner is selling the property and there's no financial distress. Well, today, here in 2013, what we're finding here at Capital Real Estate Group is the best way to identify purchase opportunities principally have been through short sales, through probate, or some other type of financial distress. One of the best ways to get a property, we find, is to identify the principals, enter into an agreement with the principals before such time that they formally put the property on the market. If in fact someone waits until a property is formally on the market, they're subject to the world, if you will, of investors also bidding on that property. As recent as yesterday, Capital Real Estate Group got a call from one of its associates, friends, partners of the firm, if you will, that was interested in unloading a property that they otherwise are going to walk away from. Well, this lady was in financial distress. She concluded that she needs to move to Las Vegas to be near her daughter and her other family. And as a result, really wasn't concerned about the property. Much of that had to do with the fact that she really couldn't afford the payment. She stopped making payments, and the property was worth less than what she owed on it. Well, it came to my attention only after a good friend of mine had met with her and let her know that there could be a solution and that there is a solution. After meeting with her, he called me and said, "Sam, I got something for you. I got a deal." The deal is as follows. The property is on the market formally for $150,000. Before the property went to market, I was in a position to present an offer to the lady to purchase the property for $140,000. You might ask, "Sam, that doesn't seem to be a great deal. If it's on the market for $150,000 and you're making an offer of $140,000, certainly you're not doing all this for $10,000, particularly if the property requires about $20,000 in rehab." We are 100% right. Although the property went on the market for $150,000, properties are trading in the neighborhood at $250,000. Yes, $250,000. Now, for some of you viewing this in Kansas, Tennessee, Mississippi, some parts of the South, you might figure that $250,000 house is a huge house. It might even be what you might consider a mansion, 5,000 square feet, 6,000 square feet, sitting on 2 acres. On the contrary, this is a 1,300 square foot house sitting on 5,900 square foot lot in a financially distressed community of Los Angeles County. But here we stand. The property's worth $250,000. Properties are trading for $250,000 in the neighborhood, and I'm on a contract to purchase this for $140,000. Now, this is a short sale, which means although the seller agreed to sell the property to me for $140,000, we're still subject to the bank approving such a sale. Now, in order for the bank to determine its sales price, or what they will allow the property to be sold for, they order what's called a broker's price opinion, also referred to as a BPO. A BPO typically is conducted by an independent real estate professional that goes out, does a drive-by of the subject property, evaluates the comparable sales in the area, also looks at the listed properties in the area, and then makes a suggestion to the bank as to the as-is value of the property. Now, you might say, well, once a BPO is conducted, they too will realize that properties are trading at $250,000. The difference is this. In preparing a BPO for a distressed property such as the subject, it's necessary that the that the real estate professional look to like properties in the immediate area of the subject and use like properties as the basis for determining their opinion of value. Like properties in this case include, but is not limited to, square footage, bedroom size, and lot size, but also the type of sale, specifically whether it's an REO sale or another short sale or possibly a probate sale. It just so happens there are a few distressed sales in the neighborhood that will serve as comparables for this property, thereby justifying a sales price or a BPO, hopefully between $140,000 and $150,000. That's the upside. And if we can get it at that amount, rehabilitate the property for another $20,000, and subsequently sell it for about $250,000 to $260,000, it's a win-win situation. Win for Capital Real Estate Group, win for the broker who referred the deal to us before it went to market. And that's one strategy that we try to use in order to identify property, identify investment opportunities that ultimately will yield the return that we want. Another opportunity is interfacing with probate attorneys. Probate attorneys oftentimes have clients whereby the estate might have real assets that need to be sold. Maybe there was a death in the family, usually that's the case. There was a death, there's an asset that's the subject of the estate, and it needs to be sold. Oftentimes, properties are in disrepair, in such disrepair that it is considered a distressed sale. That's what we like. The more work the property needs, the more attracted we are to it, because typically attorneys and other professionals overvalue, if you will, the amount of money it costs to rehabilitate a property. Therefore, allowing a savvy investor the opportunity to pick up a property, rehabilitate it for 30 to 40% of what an attorney might value the rehabilitation requires, and thereby, there's the upside, there's the opportunity to make some money. Well, it just so happens we are looking to cultivate relationships with attorneys, cultivate relationships with other people that handle property on behalf of third parties, in a way whereby we will have access to properties before they hit the open market. Again, we don't necessarily want to compete with the world. We don't necessarily want to compete with other investors out there. We're looking for opportunities, looking for ways, looking for strategies to deal directly with principals or deal with principal representatives before properties formally go to the market. If in fact we can get these homes at 50, 60, no more than 65 or 70 cents on the dollar, we like to take advantage of the opportunity. Now, one of the challenges that most investors deal with is capitalization. To have product is one thing, but to have the capital to acquire the property is another. So as a result, we are entering into various relationships with traditional debt holders as well as interfacing with some equity guys. Let me define the difference. Debt or a loan is usually secured by the real property. Oftentimes, if someone's going to buy a property, sometimes they need a loan. They'll go to a bank, a traditional bank, in order to get a loan, and their down payment will represent the equity. For example, someone might buy a home worth $100,000. A bank will require that they put down $3,000, which represent 3% of the purchase price in this example. In exchange for the 3%, the bank is willing to lend 97% of the value of the property, or $97,000. In order to do that, the bank requires that the borrower meet certain underwriting guidelines. They need to have a certain creditworthiness, they need to have certain employment, as well as certain employment history, and of course the equity or the down payment in order to buy the property. So in this example, you see where debt or a loan is required and equity is required in order to complete the transaction. Well, as investors, oftentimes we need debt as well as equity in order to complete our transactions. The cheaper the debt, the cheaper the equity, or the cheaper the cost of capital, the better the deal usually pencils out. However, if the underlying asset is in such disrepair, more times than not, the lender will require that the borrower or investor pay a higher interest rate than what's conventionally out in the marketplace. And today, 2013, an owner-occupant can get financing anywhere between 3.5% to 4.25%, 30-year fix. In the world of hard money or private money, oftentimes a borrower or investor is paying anywhere from 10 to 12% for the money. Why would someone borrow that type of money at that rate? One, they need it. Secondly, there's nowhere else to get it. And so, on occasion, yes, we borrow money and we pay what you might consider a very high interest rate, sometimes 12%, 12.9%, 13%, in addition to the point on the loan. And the hypothetical we mentioned earlier, if in fact we identified the property to be purchased at $140,000 and we put down $40,000 or $28,000, $28,000 would represent 20% of the purchase price. If in fact we do that and seek debt for the balance, then we expect to pay anywhere from 12 to 13% for that loan. All of this is washed out by the time the property is sold. If, for example, we assume a 10% cost of capital on the debt side, I'm not speaking about capitalization cost on the equity side, but if on the debt side it costs 10% and someone's borrowing $132,000 or $122,000, it's 10% a year, that's $12,200 in interest payments that they would pay over the course of 1 year. Typically our projects run the course of about 6 months. So to keep math easy, 12,200 divided by 2 is $6,100 in interest that we would pay on a loan of $122,000. If we invest our own equity in the deal, equity to close the purchase as well as equity on the construction, and such equity costs $40,000, and we charge ourselves 10% on our own money, then 10% annualized is $4,000. For 6 months, it's $2,000. So we see in this hypothetical, both the equity and the debt are 10%, and the cost of the same in real dollars is $6,200. So if we purchase the property for $140,000 and add our capitalization cost, we are at $146,200. I think I did my math right. If I didn't, I think you understand what we're trying to accomplish here. For the sake of example, if we buy it for 146, strike that. We buy it for 140,000. We have capitalization costs of another $6,600 or $6,200. We now see we're at $146,000 at a minimum, because typically there are points to be paid on the debt. Oftentimes we pay as much as 3 points or 3% of the loan amount. You can see on $122,000 at 3 points or 3% that we are now paying as much as $3,600, $3,800, $3,900 just for the privilege of borrowing the money, in addition to the interest that we have to pay. You understand? So in this case, a $140,000 purchase on real property could cost us $150,000. Once again, if the real property upon rehabilitation is worth $250,000, we don't care that we pay 10% on debt or 10% on equity. Once all costs are calculated, once the rehabilitation is taken into account, once the cost on sale is taken into account, if the organization can realize a minimum of $25,000 to $30,000 as net profit, adjusted net, we consider that a good deal, particularly if it can be made within 6 months.